Welcome to our market update for December 2022. I'm Daniel Rolly. I head up the investment team at Financial Decisions. The last few years have seen historic challenges thrown at society, the economy and financial markets. COVID lockdowns, changing work behaviours, record levels of government and central bank stimulus and a technology spending boom. 2022 has seen many of these trends reverse, and the prospect of higher interest rates, higher inflation and an economic slowdown have coalesced into lower asset prices. For long-term investors, the softness over the last year comes in the context of a strong multi-year returns. Over the last 3 years, the Australian and US stock markets have returned 19% and 31% respectively. The most important question for investors is what is in store for 2023. We think it could be a tale of two halves. The first half being lower inflation and a slower economy, but still rising interest rates, while the second half should see interest rates flattening out and potentially declining due to an economic slowdown. The X factor next year will be the China economy and their reopening after COVID, which will likely grease the wheels of global supply chains and boost global aggregate demand. Now let's get into a few observations for the major asset classes. Firstly, the stock market will face a push-pull dynamic over the next 12 months. It'll be buoyed by interest rates no longer rising, but weighed down by slower corporate earnings growth. Secondly, in fixed income markets, bonds are now offering a good rate of return due to higher cash rates and wider interest margin spreads. For example, investment-grade corporate bonds are yielding between 6 and 7%, and government bonds are yielding between 3 and 4%. This is the first time in many years that we are increasing our allocation to fixed income investments due to both the attractive yield and diversification benefits that they offer. Next, onto listed property. The value of listed real estate investments have declined alongside the broader share market and are pricing in 20 to 25% reduction in valuations, which we think is relatively conservative and offers an appealing margin of safety going forward. In addition, the distribution yields from many of these investments are attractive around the 5 to 6% mark. Finally, on cash, the silver lining to rising cash rates is income-focused investors can now earn a rate of return on their cash holdings, which is a welcome relief. In conclusion, as long-term investors, we are thinking of opportunities on a scale of 5 to 10 years, while also being mindful of the near-term challenges posed by slowing economic growth. It's rarely a case that investors should be all in or all out, and we firmly advocate a diversified approach to investment that prefers time in the market over timing the market, and we are always focused on quality investment selection. Finally, as we enter a new calendar year, we've updated our long-term portfolio return expectations. Given lower asset prices and higher interest rates, our starting point is more favourable heading into 2023. This is illustrated in our long-term expected returns, which are currently about 2% per annum higher than at the same time last year. For example, our balanced risk profile portfolio should expect to earn around 6.1% per annum. We want to thank you for your ongoing support throughout 2022 and wish you and your families a safe and happy holidays. We look forward to providing you with updates in the new year. If you have any questions at all, please reach out to the team at Financial Decisions.